If you're anything like me, diving into the world of finance might seem daunting, especially when faced with complex terms like net profit margin or net margin. But don't worry, we're here to break it down for you. Net profit margin, often referred to as a simply net margin, is a crucial financial ratio used to gauge a business profitability. It measures how efficiently a business can convert its revenue into actual profit. In simple terms, it answers the question: for every dollar a business earns, how much of it becomes profit? Net profit margin is calculated by dividing a company's net profit by its total revenue, typically expressed as a percentage. You can easily derive this percentage by multiplying the result by 100. Now, before we dive into practical example, let's ensure we're on the same page regarding some fundamental concepts. First, let's talk about profit. Profit in a business context represents the financial gains company achieves when its revenue surpasses its expenses. It's the positive outcome that keeps business afloat and growing. However, one of the challenges in calculating profit is that businesses have various types of expenses. It's not merely a matter of subtraction costs from revenues. To better understand this cost, let's dissect an income statement. The financial report summarizing company's revenue and expenses over a specific period. On the income statement, we start by subtraction, the direct cost of sales from revenue to arrive at gross profit. Then we deduct all operating expenses such as research and development, selling general and administrative expenses, depreciation and amortization. This process leads us to operating profits. Finally, we subtract interest and tax expenses to reach the confided net profit, often referred to as bottom line. The key distinction between net profit margin and other margin ratios lies in what expenses are considered. Net profit margin takes into account all expenses shown above the bottom line in the income statement. This comprehensive view sets it apart from the margin ratio. Calculating net profit margin an example. Let's apply this knowledge to all practical examples. Meet a tech company whose income statement summarizes its revenue and expenses over past year. To calculate Met's net profit margin, we'll need two figures, the net profit and total revenue. In the current year, Met generated 1 billion in revenue and achieved a net profit of 120 million, as indicated on the bottom line of the income statement. To calculate the net profit margin, we simply divide the net profit margin by the revenue. This calculation revealed that Math's net profit margin is 12%. In other words, for every dollar of revenue earned, Math was able to generate 20 cents of net profit. If you're like me and prefer percentage, simply multiply this result by 100. But let's not stop there. To gain deeper insight, let's compare Math's net profit margin year on year and against a direct competitor in life. In the previous year, Met achieved a 7% net profit margin, considerably lower than 12% in the current year. This improvement signifies Met's growth in converting revenue into profit, resulting in a substantial 71 million increase in net profit. Now, let's introduce Inlet, a competitor in the same industry. Inlet report revenue of 7.8 billion, significantly higher than Math of 1 billion. Inlet also boasts a whopping 1872 billion in net profit, showcasing a robust 24% profit margin. Comparatively, Inlet in earning more revenue and converting a higher proportion of it into net profit, factor influencing net profit margin. What can cause a decrease in net profit margin? Well, there are a few factors to consider. The business operation margin may have decreased, or its interest and tax expenses might have risen a proportion of revenue. These factors can collectively contribute to decreased net profit margin. On the flip side, conversely, an increase in net profit margin could result from an improved operating margin, or a reduction in interest and tax expenses and a proportion of revenue. These factors play a pivotal role in driving an increased net profit margin. Understanding net profit margin is an essential for businesses and investors alike. It provides a clear picture of a company's ability to generate profit from its operation. By comparing net profit margins over time and against competitors, stakeholders can make more informed decisions. What financial ratios would you like to explore next? Let me know and in the comment, and I'll be back with more insight in the next video.